Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, it's time for our weekly review of the SPY, which is our proxy for the S&P 500. We're going to be looking at the put to call ratio as well and the VIX today. But first, do you want to learn Elliott wave theory? Well, if so, consider joining the Green Star Trading Patreon at either tier 2 or tier 3. You will unlock this 11-part series, which is a comprehensive yet easy to follow video format, teaching you everything you need to know about Elliott wave theory. Well, maybe you want to learn how to chart the way I do as well. Well, I have a series called My Chart, which is an ongoing series which I'll be adding to every month over the coming months, which covers exactly how I set up my chart on TradingView, every tool I use, every drawing I use, every object, every indicator, the whole lot. And we'll show you how to set it up the way I set it up. You don't have to do it this way, of course, but if you're interested, there'll be a dedicated playlist of this too. And finally, maybe you just want to learn how to trade the way I do with my technical methodology, using what I call the standard trade setup. There's a playlist here for that too. We also cover things like trading psychology and risk management. If all of this sounds good to you, then you can unlock all of it by clicking on the link in the description box below, heading over to the Green Star Trading Patreon page and joining tier 2 for £10 a month. By doing so, you will unlock all of the playlists I've just shown you, as well as a whole raft of other educational content. You'll also get access to the public Discord, where there is a myriad of channels covering multiple subjects which can keep you engaged and in discussion with all the other members of our community, including myself. I also host weekly live streams which can go on for hours at a time, where I'm happy to take suggestions and cover anything anybody wants to look at, as long as they make the suggestion in advance. But if all of that isn't enough for you, then maybe join tier 3, where you get every single benefit I've just listed, but you also get access to my monthly dividend calendar and stock rating system. Finally, if neither of these appeal to you and you just want to support the channel by donating £5 a month and appreciate the work I'm already doing on YouTube, you still bag yourself an exclusive video each week. Thanks for listening, guys. We look forward to having you on board. Now let's get back to the video. Okay, welcome back, guys. Right, first things first, a quick message. I will be taking next week off from the 30th through to the 6th of June. Because it's the school half term and my daughter's going to be at home, and my entire family basically is coming down to visit baby Magnus to meet my son. So yeah, he's going to be meeting his aunt, his uncles, his cousins and his grandparents. So I'm taking the week off, putting my feet up, taking a break, so you won't be getting any YouTube videos until the 6th of June. Now, if you are interested in signing up to the Patreon, I still recommend that you do it on the 1st of June to get a full month's value out of it. And don't worry, there's plenty of stuff for you to do that first week when I'm away. You've got the Elliott wave series to go through, trading series, my chart series, access to a Discord where there's hundreds of other members, plus all of the previous educational content I've done. And I'll be hitting the ground running on the 6th of June again, and we'll be back to doing weekly live streams and such as well. So still great value in my opinion, but don't be expecting any YouTube videos from the 30th to the 6th. So right then, let's get underway. So we're here on the day time frame looking at the SPY, and we're going to start with the Elliott wave count. I think we're still in this double zigzag pattern where we've got a W here, flat for an X, and then we're working on another zigzag here for our Y wave, which is going to be considerably deeper. So let's just come into the hourly time frame here so we can get a little bit more subdivision. So you can see 535 pattern here for the W, flat pattern here for the X. Then we can see 1, 2, 3, 4 and 5 here for an A. Okay, so and then from here I'm expecting a flat into a B, and then from there we will come down in another 5 waves. Okay, so for those of you who are curious, the wave 3 is legal here. It is longer than the 1, and this is another flat pattern for the 4, 5 down in an A here. A, B, this looks like 3, this looks like 3, so I'm thinking maybe now we'll get 5 waves out of here for a C, and that'll give us our B. Now, depending on how much we retrace, that's going to impact how much lower we're likely to go. So let's just have a look. Take the A. I'm aiming for 50% retracement in the B. Okay. So now if we take 1-to-1, which is the most typical relationship of A and B, we project from here, you can see how the 100% brings us straight into the regions of 50% retracement, around 346.76 here. So we could come up, let's say you've got a slightly stronger rally, if you came up to a 61.8, we would be above the 50. Now the C can extend in a zigzag, and we're already expecting a much deeper zigzag in the Y than we got in the W, expecting the markets to really, well, you know, start to call the Fed's bluff over the next few months, or out into the summer and see what happens here, get a deeper correction on the go. And so we could extend in the C, and that could bring us down to the 61.8 target at a 318.23. That's a 61.8% retracement of the whole of the primary wave 1. This represents a 50% retracement of it. So there is an alternate. I'm not convinced, because we've had this recent little move here, this little bump here. I could get 5 waves down here complete, or I could get an ABC, A, B and C down here. This last little move has made things a little awkward. So the alternate, which is still a WXY, now looks a little peculiar, because the final zigzag is a long A, B and a very short C, highly extended A. So I don't think that's particularly likely, and not very probable. So I think it's far more likely now that this was all just 5 waves down into an A, and then we're going to get a B, and now we're going to get another zigzag down here. Alright, so sorry, another 5 waves down here. So 1, 2, 3, 4, 5, something like that, once we complete this. Now there is signs that we should rally relatively soon, sooner rather than later. So let's just take a look at what's going on here. Bear with me one moment. I'm just locating the unbalanced volume. There must be some kind of way of automatically centering the chart on the data, but if there is, I'm not aware of it. Okay, so we can see how in the MACD we've had a pretty strong bullish divergence moving higher as we've made these lows. We can see here on the RSI, similar story. We just bring up the RSI here, shrink it down a little bit. We can see how we have divergence between these two lows here. Okay, between this low and this low, we were moving from low to higher low, low to lower low, high to lower low. No sign in the unbalanced volume of that. Starting to tick up now since this recent low. And so there is some bullish divergence building up essentially now. If we just look at our moving averages for a minute, we can see that we're just poking our nose yesterday through the 60 exponential moving average, and the 10 and the 20, having crossed over, are now heading back to the 60. Now we've seen this before here, obviously here we were further away, a little bit closer, went through it, so now maybe we're going to break out. You see how we basically strengthened, or you should say that the sell-off has weakened a little bit in terms of losing its downward momentum. So this could be the opportunity to get that rally in the B before coming back down. Now another thing is, if we just come out to the day chart, actually let's come out to the week chart for a minute. Oops, just drawing on the chart, sorry. And let's come back and have a look at this. So we've only had 1, 2, 3, 4, 5, 6, 7, 8 green complete weeks during this sell-off. Can't count this week because we don't know if it's going to close green or not. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 red bars, and we've had 1, 2, 3, 4, 5, 6, 7 of them in a row. 7 red weeks in a row. Now the week of the 2nd of May was only just a red week. The same with this very bullish hammer, okay, on the 9th of May. Alright, now we did come lower on the intraday, or intra-week I should say, in the pricing here of the 16th of May, but we closed higher. Okay, now we still had a negative week overall prior to the other week. Right, we extended price lower, but then we moved away from those lows. So we could, after such an extended period of selling off, now there's no reason why saying this can't go 8, 9, 10, 11, 12 green weeks in a row, but 7 is pretty rare, 6 is pretty rare, to be honest. So things are getting quite oversold at the moment, really, seeing such a long stretch of red bars. So That's the Elliott wave count for the moment. If we come over now and have a quick look at the PCC, you can see here on my chart where I've got the extreme fear and panic lines, and I've got the extreme greed and complacency. We basically trade using this 60 EMA, 250 EMA moving averages to track the data. We basically trade in and out of this range, and we've noticed since the lows in 2011 and then the highs in 2012, late 2011, and we've trended inside of this range. Each time we've come back up, we've come roughly to this trend line. Okay, now it's just a trend line, it doesn't have to hold. Okay, but the overall theme has been gradually declining levels of extreme fear and panic. Now we're back at this trend line now, having come from new lows up to it. Now we could be in for one of these rare, once in a generational total cock-ups, right, where everything just explodes. I don't think that's necessarily the case. We could turn around from here, and then the market could come down to new lows after a short rally. This is would be much more like this, because obviously we're looking at a much shorter time period, probably more like that. Okay, as the market rallies, and then we get one lower low, maybe break this, and then we'll turn around and start our move back down. The point being, it's in extreme fear and panic situations, right, when the market bottoms. It bottomed in 2011 then, it bottomed in 2015, it bottomed in 2018 during the taper tantrum in December, it bottomed in April 2020, or March 2020, this lags a little bit, this thing does, and then now it's June, so we're getting into extreme fear and panic conditions. So even if we come higher, we're getting near a bottom. It may be a few days away, a few weeks away, maybe a month or two away, but it's close. Okay, now if we come over and have a look at the VIX, we can see how we're still kind of below this range where all the previous market lows occurred. Okay, we see here the December 24th, 13th December to the 24th December, around that Christmas Eve to Boxing Day, and basically during that period in late December 2018, market moved into this territory in the VIX. Saw here as well, this is back in February of 18. When you got August of 15 is in this territory as well. Back here, August 2011, and also May 2010. So we find all these maximum VIX readings roughly inside of this range, and we do have a couple of outliers, which is, you know, the extreme readings during the GFC here, and also during the COVID panic as well. Right, so now maybe we're in for one of those again, another massive outbreak in the VIX. But it's been incredibly resilient, it really has, considering the depth of this sell-off and how much the markets have sold off. Yes, there's a rising trend, and there has been ever since we had a downward trend in the VIX for many years, all the way up until August 2017. Now we've had a rising trend in it, but we are still hanging around below this range. Now I would still expect on that Y leg, excuse me, of our double zigzag, I would expect to come up into this range again and settle somewhere in here with a high VIX reading, maybe somewhere between 36 and 56 inside of this range, 20-point range in the VIX. If we break out of this range, we'll go for something higher, and it will probably be a sign of a much larger panic and a much larger, breakdown in the market. But coming back into this range, at roughly the same time that PCC heads into extreme fear and panic territory, that all seems to line up nicely with one more scary move down in the market, and that will be our low as and when it comes, and that will be our wave 2. Other than that, guys, there really isn't anything else for me to talk about at the moment. We've had volume has declined in the last bit of this rally, last bit of this sell-off, I should say. Sorry. Now we know that as price increases, we tend to see volume drop off. As price decreases, volume increases into these sell-offs, and this seems to still be the trend. We are experiencing, as I pointed out previously, I have to excuse my voice, it's playing up a bit after the live stream yesterday, plus I'm a little under the weather. We've had higher readings in the volume than we've had basically since the March 2020 panic. Okay, and if I pointed out before on the MACD and the RSI as well, how we've reached levels in the MACD and the RSI that we haven't seen since that panic back here in March 2020. Okay, let's come out to the weekly time frame so we can scrunch this up a little bit, and you'll see it more obviously. So let's bring up the RSI. So here was the March 20 lows. Everything since has stayed out of weekly oversold conditions until recently, and now we've popped. Right, we could push a little lower, or maybe we'll get divergence between the next leg. I don't know. From a classical technical analysis point of view, it does feel like we've done enough. Right, same with the MACD here. Big oversold, big bearish momentum. Right, it's been gradually building up for months and months. You see, boop, 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 like that. Now it's going to peak at some point, and then it's going to reverse. Okay, now Elliott wave count suggests lower. That's my primary. I think we haven't quite done enough yet. 50 to 61.8% of this rally would be a sizable chunk, a sizable sell-off. From a classical analysis point of view, we've done plenty of damage already. But if this is primary wave degree correction, fair enough. You know, we could come down deeper and do even more. Alright then, now on the weekly time frame, let's have a look at our moving averages. We can see how the 20 is about to cross for 60. Now this is similar to, in my observations, my 60 exponential moving average crossing over my 250 on the daily time frame. When the 20 comes into contact with the 60, that's normally synonymous with the market getting very overbought in that direction, or very oversold in this direction, and a sign that we're heading towards at least a temporary bottom, or a permanent bottom, a temporary low or a permanent bottom. So we're kind of in that territory now, and after 7 bearish weeks, it's time for a rally, I think. Now I could be wrong before carrying on falling down here, but either way, just getting a feeling now that we're a little overdone. And it's time for a reversal, time to correct this downward move. Right, you're going to have a correction to the trend that is now a downward trend. Okay, so still the 250 sits out round here at the 50% retracement. Now let's just have a quick reminder, since I said there's nothing else to talk about and I go off and ramble on one, then I can't help myself. So let's go back and have a look at, take off all the Elliott wave counts, and you can see how the prior interactions, let's turn it into log scale for a moment so we can get a better look. And let's just pick out our larger wave degree corrections. Right. So this one, the GFC, was a much larger wave correction at a larger cycle degree. Huge sideways correction, flat. Right. Then we've had, excuse me, I don't know why that polygon is on the chart. Let's just remove that. Then we next had the first big pullback at a larger wave degree here. Okay, below the 250. The next one was the March 2020 lows here. Everything in between those, we trend above the 60 weekly EMA, occasionally breaking through it but not coming back through the 250. This is a lower wave degree in between this large degree, and this large degree, of which we're now in a much larger move higher overall. So if this is primary degree coming up here of our first 1 and 2 of a 5th, then this should probably push itself way down through the 250. Perhaps not as drastically as we've seen here, maybe just to it, but somewhere in this region that would be expected, I think. So there is still room to come down lower, essentially, and the primary count supports it. But a rally in the short term, surely, I say surely, there's no guarantee, must be on the cards sooner rather than later, I would have thought, with just how bearish this recent couple of months has been. Alright then guys, thank you for joining me on this technical analysis of the SPY. PCC and VIX. I hope it's been useful. If you're new to the channel and you like what you're seeing, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. Feel free to leave us a comment in the comment section below, and as always, a huge thank you to my Patreon subscribers. Your support is greatly appreciated. If you are interested in joining, there's a link in the description box below. If you're not following me on Twitter yet, there's a link to my Twitter feed also, where I post whenever I announce whenever I post new videos. Alright guys, take care of yourselves, and I should be back with you tomorrow for another update before I sign off for next week. Take care of yourselves, all the best, bye bye.